Hello and welcome to NDTV Profit. You're watching this special broadcast after the Reserve Bank of India announced fresh norms for banks and NBFCs which deal with AIFs or alternative investment funds. Now, of course, these announcements came late Tuesday evening, and since then, everybody here at the NDTV Profit Studios, as well as I'm assuming most of the AIF market, is trying to figure out how exactly these norms are going to hit the industry and whether something needs to change. Now, just a brief introduction as to what exactly has happened. The RBI has said that banks and NBFCs cannot invest in AIFs if the eventual beneficiary of the funds of those AIFs are borrowers of these banks and NBFCs. And if they currently hold any such investment, then within the next 30 days, the RBI has required that the banks and NBFCs remove these investments completely from their book, sell down their units, and if they're not able to sell down those units within 30 days, then you need to fully provide against those investments. The RBI has also barred banks and NBFCs from any kind of priority distribution model which exists in some of these AIFs. To discuss this issue further, I have with me Mr. Eshwar Karra, the CEO of Kotak Special Situations Fund. Mr. Karra, welcome to this conversation. Happy New Year, I guess, from the RBI.
Good morning, Vishy. Yes, Vishy, this is, in my view, a very good development. It is in line with the RBI's thinking, which is that regulated entities should not have any regulatory arbitrage through any means or structures. I can draw parallel with the ARC space, where for many years we were all, privy of this fact that REs were using ARCs to have the benefit of a regulatory provisioning arbitrage. And since then, the RBI has over the years plugged that and brought it to parity. Similarly, now what has happened is that the AIFs were being misused, I would say, in this manner, where the regulated entities were, playing this regulatory arbitrage to avoid provisioning and moving their so-called bad loans into the AIF structure. So I think this is a welcome move by the RBI, and it has to be taken in the light of some of the things that we are aware of, which were happening in the market.
Right. Mr. Karra, just for our viewers, what is the scale that we're talking about? How big would be the problem that the RBI is trying to solve with a more or less a blanket sort of an announcement for all investments?
Vishy, I would not be able to give you a right perspective on this because the AIF space is so large. And catering to buying loans and, giving NCDs for refinancing is probably just probably 10 or 15% of the total AIF investments. We make investments, I can speak for my fund, we make investments in CCDs, which are mainly equity-like investments.
Right.
We make quasi-convertibles. We give capital, investments for growth, for acquisitions. And some form of our investments do go into refinancing. For instance, our recent deal that we announced 2 days back was that of refinancing Jaiswal Nico.
Yeah.
And so I think that would constitute probably less than 10% of the total AIF pool of capital.
Okay. And what would be the AIF pool of capital? Because that's a number that we have been trying to figure out, but I don't see any definitive estimates of the market.
Yeah, you will have to look at only Cat 2 because I think Cat 1 and Cat 3 are designed for a totally different space altogether. Yeah. So you'll have to look at Cat 2. I could, offline share with you the number that is, the funds that have been raised.
Right.
But mind you, most of this capital that has been raised for, customized funding, which is either for, funding for holdco level refinancing or for promoters to buy back their equity or for acquisition funding or for, growth capital. So more equity-like in nature. Some part, yes, I don't deny, does go towards refinancing of existing debt, which originally sat in the books of REs.
Understood. I wanted to also touch upon the topic that the RBI brought up in its guidelines, which was evergreening. Now, that's a word that they used within their note. But do you feel that this was a serious enough problem for the regulator to act, or maybe it was happening on the fringes somewhere?
I think it was prevalent earlier. Probably not as prevalent today because a large part of the NPLs have already been resolved. But this has been done as a measure to stop any future misuse and arbitrage of provisioning. So what they have done is they brought the provisioning to parity. Okay. They are saying that, look here, you can't fund through an AIF, a refinancing proposal which effectively involves reduction of your existing NPA or to become NPA. Yeah. So, but that I would like to say is one end use. However, I would have gone to the extent of saying that there are genuine cases as well because the banking system as a whole is huge. And my AIF also falls within, the management company, the alternate assets group falls within the umbrella of a large private sector bank. Yeah. And I'm not privy to the exposures at all. It is an ocean, and some of these companies I may be assessing would actually have approached my bank or could have an exposure with my bank on the working capital front. Yeah. So I think I would want to caveat this while the intent is very good, and that is to catch these people from misusing the AIFs to evergreen their existing exposures. Yeah. But some caveats is what, of course, we're seeking clarification as well. But some, amendments or clarifications are sought because, for instance, if I were to make an investment, an equity-like investment in a company where my sponsor bank also happens to be a working capital lender. Yeah. Now, these are two different investments completely. Correct. And so I would go to the extent of saying that if my investment does not lead to a reduction of the exposure by the RE, which is the bank or NBFC, then it's fine. Correct. Because the end use of my proceeds is not to refinance the existing RE's exposure. So if that exposure is not reducing, I don't see any issue.
Mr. Karra, but couldn't one make an argument money is at the end of the day fungible, so defining exact end use might be a little difficult for anybody in the system?
No, it's quite easy because let's say the RE had an existing 100 crore exposure with the company. Yeah. And the AIF, in which the RE is also one of the investors, has invested, and the AIF, mind you, is independently governed and managed, and we make an investment of, let's say, 50 crores in the same company. If it has not resulted in a reduction of the 100 crores original debt, right, then it's very clear that the end use of this money has gone towards growth. Got it. And not towards refinancing or evergreening of the asset, right?
Understood. Last couple of questions from my side. I wanted to first understand from you, who does this impact now going ahead? Are private credit funds part of this discussion? Special situation funds like yourselves, are they part of this entire, within the ambit of these guidelines? Who all gets impacted by this?
All the Cat 2 AIFs will get impacted by this because I'm sure quite a large number of them would have sponsors who would be REs. Right. So whoever have got RE as their sponsor and they're raising funds through that, they would be affected because they have to make sure that, and the other part is that even if we were to make this investment, it says that you need to provide 100% on that the RE needs to provide 100% on the entire investment. Correct. I think there should be a clarification saying that only to the extent of the end use going towards that company, right? Okay. In which the RE had an exposure. So not the entire investment. Why should all the other investments also be provided for? So I think that is another clarification which would be in order to clarify this position.
The last
But
question
all
from my
AIF
side.
Cat
Yeah.
2s will get affected if they have REs. And there are a whole lot of NBFCs who have actually invested in AIFs.
Understood. Last question from my side. There's a very tight 30-day deadline that the RBI set for unwinding these investments. Who's the buyer at the other end? Is the market deep enough for these REs to exit these investments without it becoming a bit of an issue?
It will be a big challenge, Vishy, because understand that they're the sponsors. Most of them are also sponsors of the AIFs. And sponsor commitment is mandatory because of, let's say, it could range from anywhere from 5% to 25% of the corpus of the AIF.
Yeah.
And because he's putting in that money, you are able to raise the balance, whatever, 75 to 95% from other LPs. So if you pull out the capital from the sponsor, in 30 days, the whole AIF will collapse, right? The fund will collapse.
Correct. Understood.
So
essentially,
it's not so easy.
You would need a little bit more clarification from the RBI as to whether sponsor funds need to also withdraw.
That's right.
Got it, Mr. Karra. Thank you so much for taking us through all those details. It was a pleasure talking to you. And thank you so much for watching NDTV Profit.